So hi everybody, this is Also Hub. I'm Giacomo, and today I'm again with Marco Santanché from Unbiased Alpha. And today he's going to talk about trading strategies as the previous two videos. So if you haven't watched the first two videos, make sure to check them out. And Marco, we've introduced yourself in the previous videos, so let's get into the content of today.
Thank you, Giacomo, and hi, everybody. This is the third episode for Systematic Strategies. We are currently discussing asset allocation, which is the natural next step after trading signals, which was the previous episode. So, trading signals are normally used for identifying entries and exits for our strategies, and sometimes even the size or confidence we have in these strategies. But asset allocation is normally what we actually do for allocating capital towards different signals or assets. We cannot avoid asset allocation because even if we do the simplest possible model, so being fully invested into a single asset, we're still doing an allocation decision, and this decision will impact the performance much more than the signals, probably. So many traders or investors think that we can allocate capital equally across all assets and invest, including their trading signals, models, or anything else, independently from each other. But since we are one individual with the same portfolio, this is not really sufficient to diversify risk and to control for not only for risk and diversification, but also for the return profile of our strategy. And asset allocation is indeed more complex than equal weights. And yeah, while signals can be simple, we could even have just a buy and hold signal forever for some assets and invest in that. Asset allocation needs normally some more nuances, more complex models, and more theoretical and practical assumptions and theses. Many traders indeed invest in all available assets or at a single point in time, but they subset the universe of the assets, maybe qualitatively or according to their preference, or even worse, according to backtesting results and the performance. This is normally not the way to do that, because you are ignoring probably the fact that there are other assets that you could invest in, so the decision must be done for a specific reason. And normally this shouldn't be performance, because past performance is not indicative of future returns, as we always read in reports and disclaimers from websites or anything else. So equal weights are insufficient, also because if you subset the assets you prefer, you get basically a different portfolio, even if it's equally weighted, but on a different subset of assets for a discretionary decision that might be wrong, and it must be motivated. While it seems neutral, we have the problem of allocating also equally to every signal. Not every signal is the same. Maybe some market conditions could make signals more or less important. We allocate equally to every asset, and apart from the universe decision, every asset is different, especially in terms of risk reward and contribution to risk to your portfolio. Correlations and covariances are ignored, and which is a consequence of the previous. So we are basically allocating to every asset regardless of what they actually bring to our portfolio. And yeah, we ignore the prior selection, and also we ignore fees. Sometimes it might not be ideal to rebalance and give equal weights for example, every single day or every week, because we pay more fees than what actually needs to be achieved with this rebalancing. So maybe it's better to leave our weights drift a little bit, or rebalance according to models which actually include the trading fees we are going to face when we have to rebalance. Can a better allocation impact performance? So is asset allocation that important? Will it really improve your returns dramatically if you have a better allocation models than, for instance, equal weights or fully invested? Well, there are some benefits that we can really understand very, very intuitively. We don't need to study any model for that. There's surely a better risk management in a more complex model that should theoretically tackle all these aspects, for instance, covariances, and the fact that signals have correlations by themselves in the model to some extent. So not only asset returns are correlated, but also the signal that comes out of the data could actually be correlated for the model that basically brings to be long, for instance, in all signals, or short in all assets, sorry, or short in all assets at the same time. And better returns, yeah, it's not only about risk, it's also about returns. Given the same weight to each asset could be detrimental to returns because we allocate similar weights to assets that actually perform worse, for instance, give lower returns, like such as fixed income. Imagine if we were 50% equity and 50% fixed income. Of course, we have lower returns than someone that is actually 80% equity and 20% fixed income. So we must take into account returns as well, not only the risk contribution. And there are better fees normally, because if the model is capable of including fees in the calculation or in the optimization, definitely we will pay lower fees when using these models rather than a naive rule for asset allocation. And we can develop more complex solutions, and sometimes complex is not always better than simple, but sometimes, and usually, this should bring to better target. For instance, we can take into account tail risk or drawdowns or any other performance or risk metric that we want to optimize. There are some very famous examples of asset allocation models. In particular, the first most prominent example is the model developed by Henry Markovitz. This is a very famous optimization model, probably the first one, looking at optimizing asset allocation by either minimizing risk and achieving a target return, or maximizing return and with a given target risk. This is called mean variance optimization, and it is based on the famous CAPM model, which is considering the efficient frontier of assets that we need to invest in. And yeah, it's probably very old as a model, but still somehow valid, or it at least this model, the Markovitz model, helped us further researching new approaches, and asset allocation evolved since then, because it was really considering risk contributions and the covariance matrix when allocating, and not only the target returns or the expected returns. Then, of course, we have naive asset allocation models. These models are very basic, for instance, the equal weights model or the fully invested model. And sometimes these models are also assigning weights according to the expected returns and risk for an asset class or asset. For instance, the 60-40 all-weather portfolio, which is based on the assumption that equity will contribute more in risk and in return to our portfolio. And so 60% is allocated to equity, but 40% for diversification benefits is allocated in fixed income. Then we also have more recent models, for instance, risk parity, a model developed by Bridgewater Associates, a very famous hedge fund. And they allocate according to the risk contribution. For instance, in this model, of course, they deploy even more complex models, but the most basic definition of risk parity is allocating to equal risk contributions, which is not equal weights, but it's taking into account the contribution to risk of each asset and allocating some capital according to the contribution itself to the covariance matrix. Now, this is an example of how asset allocation can impact performance. So in this example, we can see two charts with a very simple model investing in the top stocks in the S&P 500, for instance. In this case, Amazon, Meta, Apple, Microsoft, Google, and Netflix. And the signal is basically momentum, going long or short according to the 5-day cross-sectional momentum. And in one case, we rebalance every week with equal weights. So every week we set the weights back to being equal. While in the other case, we rebalance according to risk parity. So every week we rebalance according to the model, and the model will run and the optimization in order to find the new optimal weights with a look back window of a year for the covariance between the assets. And it is very clear that performance is much, much different. In particular, we can see a very, of course, a better Sharpe ratio overall, but also better return. And yeah, most importantly, volatility, because we know that risk parity is actually aiming at optimizing from the risk perspective. But in any case, the performance is dominant of one of the two models against the other one. And that's because we have a more sophisticated approach and a very sounded way of implementing it. Asset allocation doesn't come without risk, of course. So we must be careful because there's no one-size-fits-all model. And that's always true in every field, I guess. But for asset allocation, it is particularly true because the assets we select, the approach we follow, and the market conditions can really change the approach we follow, especially in terms of signal. That's what I mean. And market conditions can really contribute to a different performance of the same model. So it could be that equal weights sometimes outperforms even some of the other models, which by itself doesn't make it a better model because we know that equal weights is actually just naively allocating. And so it could be by chance that we have better returns or better risk-adjusted returns, but it doesn't make it a better model, so to say. And yeah, we can prepare on a forward-looking basis. So of course, future returns cannot be predicted at all times. Normally weights prepare us to that, but there are sometimes some surprises and some sudden changes in the correlation, for instance, between assets. So of course, there's some risk implicit by the let's say by the action of investing. So when we invest, we all are always exposed to surprises that we cannot predict. There's nothing we can do about it, even if we have the best asset allocation model in the world. And of course, more than signals, weights can expose us to model risk. Why more than signals? Well, it depends on the model again, but signals can normally be controlled by weights. But if we invest wrongly in weights, yes, we can have some stop losses or some other system, but model risk is there, and it's very important because if the model overestimates or underestimates the risk contribution of an asset, we will get probably a lot of exposure to an asset which we actually shouldn't invest that much, in particular because of risk. So it's very important to understand why a model is telling us to invest, for instance, 60% in a single asset or asset class, and what is it looking at, and how we can actually mitigate maybe model risk, adding additional models or additional risk controls to the investment process. So as a conclusion, asset allocation, yeah, is part of our lives in anything, and we can't really avoid it compared to signals. It's crucial to prepare for the future in the best possible way with asset allocation, with a solid asset allocation model. And models can make mistakes, can bring risks, can make, let's say, not suboptimal decisions. So we must always understand why the model is targeting some specific risk or return profile for our portfolio. And we must also take control over these variables in the model.
Okay. So that was a very interesting presentation. You showed a lot of interesting data regarding the performance of the top stocks, if you have a trading strategy or not. So thank you again, Marco, for taking the time and explaining all this to us. So if you have anything else you want to add, feel free to do so. If not, I really want to thank you for taking the time.
Thank you, Giacomo. Yeah, that's it on my side. I'm always happy to answer any questions or doubts from anyone. So if you want to send an email or contact us, please feel free to do that. And through our channels at Unbiased Alpha. And yeah, happy investing.
Okay. So thank you again for taking the time. This is it for today. I'm Giacomo. This is also Hub. See you next time.